We're opening today's deep dive with a macro alarm bell that's rattling every corner of the market this morning. Manufacturing purchasing managers, the people actually running factory floors and signing supply contracts, are now describing their inflation environment as worse than anything they experienced during the pandemic era. That is a stunning characterization, and it carries enormous weight for Federal Reserve policy, for bond markets currently pricing the 10-year Treasury yield at 4.63%, and for equity indices like the S&P 500. This is not a minor data wobble. This is a structural signal. The headline finding from the Manufacturing Purchasing Managers Survey is that the prices paid subindex may have printed above 65, indicating aggressive input cost inflation across the supply chain, levels that analysts specifically flag as signaling pricing power stress. The ISM Manufacturing PCARD Medical Consensus benchmark sits near 50, the neutral dividing line between expansion and contraction, with prior mid-2026 readings trending between 48 and 51. A prices paid print above 65 would represent a dramatic departure from that baseline and would force traders to immediately reprice inflation persistence risk. Inventory and production schedules are already being disrupted, compounding the pressure on downstream companies. The reason this survey carries major impact is that it directly attacks Federal Reserve policy credibility. The Fed has been navigating an extraordinarily difficult dual mandate, containing inflation while avoiding a hard landing, and purchasing managers saying conditions are worse than pandemic-era volatility suggests that monetary tightening has not yet fully broken the inflation cycle embedded in manufacturing supply chains. Gold futures are up 3.67% today, and silver is up 3.48%. Hard asset markets are already voting with capital. These are not random moves. Sophisticated money is hedging against a scenario where the Fed is behind the curve on inflation again. Let's walk through the transmission mechanism precisely. Industrials via industrials and materials via materials face direct headwinds from elevated prices paid inflation and demand uncertainty. Input costs are squeezing margins while order visibility deteriorates. The S&P 500 is trading higher, but that headline green masks significant dispersion. The NASDAQ 100 is outperforming, riding the perceived Fed pivot narrative where inflation fears paradoxically boost long-duration tech. The Russell 2000 is the most exposed to a growth slowdown. On the safe haven side, long-term treasuries benefits from any bond rally, and gold is the direct inflation hedge already accelerating. Energy adds a modest tailwind to the complex. The single most important number to watch in real time is the 10-year Treasury yield at 4.63%, already down 126 basis points intraday. A sustained break below 4.50% is the technical tripwire that signals a broad risk-off repositioning. Bonds would accelerate, equities would face selling pressure, and gold would likely test the 4,300 resistance level that analysts are flagging as the next critical breakout zone. The VIX at 16.67 remains relatively contained despite the macro noise, but a move higher would indicate that options markets are beginning to price genuine fear. Watch the S&P 500 support near 765 and the NASDAQ 100 support near 715. Those are the floors where institutional buying interest should emerge or fail. Here is the cleanest way to frame what today's manufacturing survey means for your portfolio. If the formal PCARD medical data confirms what purchasing managers are already describing, prices paid above 65, supply chains destabilizing, inflation worse than pandemic era, the bond market will rally hard, yields will fall through critical support, and equity volatility will spike as investors are forced to simultaneously price higher inflation and slower growth. The stagflationary combination the Fed has least room to address. Safe havens, gold, long-duration treasuries, defensive staples, and utilities are where institutional capital rotates in this scenario. That is the one story that matters most in markets today, and the full breakdown is right here. If this kind of deep, analyst-level market breakdown is what you need every trading day, hit subscribe right now and tap the notification bell so you never miss a segment. We cover the stories that actually move your portfolio every weekday before the open.